to our second episode of the CIMA revision program, our subject being Financial Management, F2. I am Malik Desilva. Now at the previous segment we focused on group accounts, which takes about 35% of our syllabus, and at the same time we took some time to focus on earnings per share and developments in external reporting, which is part of section C and section D. Today, ladies and gentlemen, our main focus would be on the interpretation of financial statements, which takes about 35% of our syllabus weightage. Now in this area, apart from the ratios report, we have earnings per share, which we have discussed already, operating segments, creative accounting, where you manipulate financial statements, and limitations attached to ratios. So, section B, a 25-mark report is guaranteed on this area. We must write the report. Now this is a serious concern to Sri Lankan students, where we are very good and we like the numbers, but when it comes to writing a report in the English language, in the Suddha's language, we struggle. We don't like it. We are not good at it either. But remember, it's a skill which can be acquired, and how you get this skill is by writing as many reports as possible, then comparing it with an appropriate answer, and then identifying your mistakes. Now my question to you is, how many reports have you all written by yourself? Critical. If you haven't, make sure at least you write 5 reports on your own. Do 5 past papers. Compare it to the CIMA examiner's suggested answers. Time it within 45 minutes and see how it goes. Now in class I introduced something called report cracking methodology, where we look at 25 steps to earn these valuable 25 marks, and much of it I would be discussing over this program. So, in a typical scenario, we got to read, understand, and identify what our role is. Sometimes we are advising an investor whether or not to buy shares, or maybe we are advising our senior management whether to buy over a certain company that we are evaluating, or maybe we are advising one of our friends whether to join this company or not, whether it is a stable employer. Or sometimes the examiner will say that you are working in a bank and you are assistant to the bank manager. Now a prospective customer is asking for a loan and the financial statements have been given. Now we got to analyze these financial statements and see and recommend whether to give the loan or not. So it all depends on what our role and how we adapt into our role. So my advice, ladies and gentlemen, is we got to get involved with the scenario. When you read through the paragraphs of the examiner introducing this company, try to relate this to a Sri Lankan company and see whether you can draw some parallels, either, as I said earlier, to a Sri Lankan company or even maybe a company worldwide that is known to you. And then we need a proper report format. Sometimes the examiners say about allocating 1 mark just for the report format. Now just think, if you are stuck at 49, how valuable that mark would be. And then the respective ratios are generally prepared in an annexure. So the ideal format is first you have the report followed by the annexure, so that the examination, maybe you can keep about 2 or 3 pages for the report, and then do the table of ratios where you calculate and then start writing the report, so that when the examiner marks your script, it is very well laid out. There again, generally examiners allocate about 8 marks for the ratios, which means we don't need about 25 ratios. Maybe about 10 to 12 ratios I believe is sufficient. But the majority of the marks is not merely by stating the ratios, but how you relate the ratios from one to another and to the circumstances faced in the scenario. So pointless just saying that turnover went up by 10%. Anyone can say. Can we identify as to why the turnover went up? Whether the company's growth strategies have been successful? Or somebody might say GP margin has come down by 4%. Why did the GP margin come down? Were we having a price war? Or were we expanding our business? As a result, we had to give price discounts. Now that's the type of thing which our examiners expect at F2 level. So, what types of ratios can we normally calculate? So now I'm getting on to the annexure right now. You can look at the turnover growth. You can look at the GP margin and the increase or decrease. The percentage growth in expenses. Expenses taken as a percentage of sales. The profit margin, it can be the operating profit, the PBT, PAT, depending on the case. You can look at the finance cost, the growth in the finance cost, related to the interest cover, calculate the gearing. Now later on you will see that all these ratios will try and connect. And then what's the return the shareholders are getting, your ROCE. And then looking at the balance sheet, your non-current asset turnover, your inventory period, your receivables period, current ratio, quick asset ratio, gearing are some of the ratios you could calculate. Then when you write the report, plan your answer. Try and establish some relationships, as I was telling you all earlier. So for example, if the GP margin is coming down, what is the impact of that on the bottom line? Why did the GP margin go down? Is it because of competition, or whether the raw material prices have gone up? Reasons for the increase or decrease in turnover. The behavior of expenses. Yes, comparing with budgets, comparing with last year, and all those things. And when you take the finance cost, relate it to the gearing, relate that to the interest cover. And these are little things you could do. Now, I thought of referring your attention to a scenario in May 2010, question number 7, where we are advising a friend whether or not to hold the investment in this company called KER. Now, in the chairman's report, it says that the success of the company, citing that there's an increased revenue in profits during the year, and that the company has heavily invested in non-current assets. So when you look at the numbers, you will actually see that the turnover is in fact going up by about 40%, from 1 million to 1.4 million. The profits are also going up from 90 to a million to 120 million. So on the face of it, looks like what the chairman is saying is correct. But when you deeply analyze this, you will see that although the turnover is going up from 1 million to 1.4 million, the gross profit is going up only from 317 million to 372. So there is a deep drop in the GP margin, the drop of GP margin of about 5%. And when you quantify the impact on the GP margin is about $71 million. Now there again we saw that the profit is going up from 90 to 120. But during the year there is a acquisition, or where we have invested in an associate company which is contributing a profit of 80. Now if you remove that 80 of the equation, you will see that in actual fact the profits are coming down. Yes, and the PAT margin is coming down from 9% to 2.8% if the associate is eliminated. So in actual fact there is a dip in the performance when you really analyze the information. So this is the type of thing that your examiner would expect. There again, in lots of these questions, the examiner would ask for a part B or a part C, where they would ask for what additional information that we might require. It might ask for things like limitations that we might see in our calculations, and by studying up the respective theory we can jot in some points and earn some valuable marks. There again, in most scenarios, a common thing that we see is that there is a huge cash crisis. You will see a favorable cash balance at the beginning of the year turning out to be an overdraft balance at the end of the year. Now ODs have a high interest cost, and then you will see the interest cost is going up. The gearing is going up slightly. And if you take the average cost of borrowing, where you divide the finance cost by the borrowing, you will also see that the rate of borrowing is also increasing. Then coming on to your working capital, see whether your stock days are increasing. It may indicate that there is a obsolete stock. Or if debtors days are increasing rapidly, whether we have bad debts. Sometimes the payable days are drastically coming down and we think it's good, but are we doing it in an ethical manner? Yes. Or are we just postponing payments, and as a result the payable days are increasing? So all these things have to be looked at. Now focusing on some other areas, another popular area with the examiners would be operating segments, where we disaggregate the information and see how various business sectors are performing. Now this is coming under IFRS 8. So, and something which is very popularly tested is that whether this would have a significant impact on the expenses, the cost of preparation. There the point is that operating segments are based on information which is reviewed by the chief operating decision maker. So there is a cost attached, no doubt, but may not be a significant increase as the information is anyway available. Another popular area that your examiners are asking is as to what benefits operating segments, by having operating segments, that investors would have. They would have a better understanding about the entire business, because a group picture will give the total. The segmental information will exactly indicate that which sectors are performing well, which sectors are performing poorly, what are the growth sectors, what are the sectors which are in decline, and it would give loads of information, and also various risks attached to different business segments could be identified. Then another area where we can focus on section C is on creative accounting. Now in the good old days we call it manipulating of profits, but now a modified term, creative accounting, basically refers to the manipulation of figures. Then examiners might ask the methods used. You adjust your timing of transactions. By creating and reversing provisions, you try to do something which is called artificial smoothing. Everyone likes a nice trend line. But if results are fluctuating, you manage your provisions in such a way to smoothen it artificially by adjusting classifications, classifying expenses as assets. You manipulate your results. Sometimes you don't account for liabilities and expenses incurred towards the end of the year. So by excluding liabilities, again, you show a different picture. So there are lots of reasons like that. And another thing that what examiners would ask is that why would companies resort to creative accounting? One is for tax purposes, to avoid your tax, and then to gain shareholder confidence by having a nice trend line and all that. For personal gain, because if the bottom line is good, you get your bonuses, incentives and all those things. Sometimes for indirect personal gain, say your reputation. Who would like to say that you are working for a loss-making company? Yeah. And then sometimes if you are in a big group, if other subsidiaries are following some malpractice, you also tend to follow the pack. Or to meet commitments given to banks, the stock market and all those things, people resort to this So members, we should never resort to this in our professional careers, but at the examination, we should be ready with the answers. Hi everyone and welcome back. Now let's focus on one of the most important areas of the F2 syllabus, which is financial instruments. Financial instruments is all over. Examiner can give financial instruments as a separate question in section A, or he can mix it with the consolidation in section B, whether it may be a consol balance sheet, income statement, or for that matter a cash flow statement. So any member, if you are planning in doing the F2 examination in a couple of days time, can't afford to take a risk of not studying financial instruments. So what's our scope? Whole heap of definitions which we have to be familiar with, and then we have the normal principles of financial instruments. When I say normal principles, I mean to the standard financial assets and liabilities. And then we have the hybrid financial instruments, where some instruments say has both the characteristics of equity as debt, and then some basic level of testing is involved in derivatives and hedging as well. So what do you mean by financial instrument? I refer your attention to slide 46. It's any contract that gives rise to both a financial asset of one company and a financial liability or share capital and equity instrument of another company. That's what we mean by a financial instrument. Then what do you mean by a financial asset? Is any asset that is cash. So if you are having cash, it's a financial asset. Or a contractual right to receive cash or another financial asset from somebody else, say our trade receivables. Or a contractual right to exchange financial instruments with somebody else under conditions that are favorable. Or if you are holding on to any shares of another company, let's say you have invested in shares in some other company, that will become one of your financial assets. Financial liability is any liability which is a contractual obligation to deliver cash or another financial asset to another entity, your trade payables balance, or to exchange financial instruments under conditions which are potentially unfavorable to the company. Then what do you mean by an equity instrument? It's any contract that evidences a residual interest in the assets of a company after deducting all liabilities. That's what we mean by an equity instrument. So what are the reporting standards? Right now there are three standards. IAS 32, which talks about the classification, then IAS 39, recognition and measurement, then disclosure requirements in IFRS 7. Now going forward, purging all this, we have IFRS 9. And one critical thing which examiners test on financial instruments is how you would classify. Say when you are raising some capital, is it share capital or is it a debt, which is addressed in IAS 32, and the entire classification is done based on the substance of the transaction. A common thing which comes under this area is about redeemable preference shares. So preference share is a share capital. So we have a tendency of classifying it as equity. But there is a redemption clause, which means the issuer has a contractual obligation to pay cash to the preference shareholders on the redemption date, which means there is an obligation to settle. So can we treat it as equity? It's a debt. If that's the case, the preference dividend would be captured under finance expenses and not under the equity statement. So now let's take our attention to a past paper and I am referring to September 2013, a recent paper, question number 4, where this company called EMS is issuing 5 million 6% redeemable, within quotes, redeemable preference shares at their nominal value. And then they say the issue cost is 200,000. So you are raising 5 million, incurring an issue cost of 200,000. Your net proceed therefore would be 4.8 million. Now how do we capture this? Do we write off the issue cost as an expense, or you set off against the amount borrowed? Part A, it says A1, explain how this instrument should be classified. Now, earlier as I was saying, the classification of the redeemable preference share. I think I made the explanation already. There's a contractual obligation to deliver cash to the shareholders on the redemption date. Therefore, we need to classify this as a liability, as you now see on slide number 54. Now at the same time, the issue cost, you don't expense it, but you set off against the liability. So your net proceed, the accounting entry would be you debit your bank and credit your liability by 4.8 million. And then they ask how to treat the preference dividend. As I said earlier, because the instrument was now classified as a liability, the 6% dividend would be classified under finance cost in the income statement and is deducted in arriving at the profit for the year. Now there's a part B of this question. Now if part A was about a financial liability, in part B we are investing in a instrument which is a financial asset. So now financial assets are broadly in 4 buckets. That is, if you invest in shares in a company, it can either be an investment where we classify as fair value through profit or loss. If it's a short-term investment where you want to play the stock market, or if it's of a more of a long-term nature, we would call it an available for sale financial asset. The other 2 categories are loans and receivables and held to maturity investments. So the first 2 categories are taken at fair value as at the balance sheet date, where the gains are taken to the income statement when it comes to fair value through profit or loss financial assets. It's taken to OCI if it is an available for sale investment. Loans and receivables and held to maturity investments are held at amortized cost. Now in this company, referring to September 2013 question 4, MAT made an investment in a financial instrument at its nominal value. It is a fixed term and cash flows are constant, and MAT intends to hold this investment until its redemption date. What an important clause. It intends to hold it until the end. So where do we classify? We classify this as a held to maturity investment because it is having a fixed term with fixed cash flows, and the company has the intention to hold it until maturity. So now the initial investment is 2 million and there's an issue cost of 100,000. Now where do you recognize the issue cost? Once again, you recognize the issue cost along with the financial instrument. So the initial cost, the initial measurement would be 2.1 million. Now please keep in mind that if there is a issue cost involved with short-term shares, fair value to profit or loss, that you take it under expenses. And even if you make an available for sale financial asset, still the issue cost would be capitalized. And then you prepare the amortized cost table as you see in slide 56, taking an income of 8.4%, which is 176, and the coupon interest is deducted against the asset and showing a final balance sheet figure of 2.1 million. Let's take a break and be back short. Hi everyone, welcome back. So up to now we've now covered group accounts, previous day 35%, interpretations another 35%, 70%. We just touch based on section D as well, 10%. And now we are down to the final 20% of the syllabus, which is section B, recognition and measurement, of which financial instruments we have discussed in our previous segment. Now, for the moment, let's take a look at employment benefits, which is discussed in IAS 19. So, when you are in employment, there is a cost attached to the employer. And what are the types of employment benefits which we see in practice? We have the usual short-term employment benefits, monthly remuneration, post-employment benefits, any other long-term employment benefits, various schemes you have, and benefits upon termination. So, of these four categories, what is going to be our focus for F2? Our focus is going to be on post-employment benefits, which is the second bullet point which you see on slide 82. So, what do you mean by post-employment benefits? Basically speaking, it refers to pension plans. Now, that's our focus. So, pension plans can be broadly categorized into two based on how they operate. One, we call it as a defined contribution scheme. The other is called a defined benefit scheme. Now take in Sri Lanka, take the EPF. That's a defined contribution. Every month we know how much to contribute, how much from the employee, how much from the employer. So accounting is less complicated. You account for it according to the basic accruals basis of accounting. Any amount overpaid or underpaid would be adjusted as a prepayment if you have paid more, or an accrual if you are falling short. So less complications there. Now, defined benefit scheme, what is that? That is where you define the ultimate benefit that the employee would be getting. In Sri Lanka, if you take the gratuity, if an employee works for more than 5 years in an organization, let's say he works for 8 years, then you are entitled to half your final salary into the number of years of service. Now that becomes a complicated calculation, because we can't exactly say how many people will leave, how soon they will retire. Yes, and lots of complications involved. Now to do this computation, we need the services of an actuary. And once the actuary gives us the numbers for F2, we need to be focused on the accounting. Now just another point which I would like to mention on the defined contribution scheme is that once the contribution is made, thereafter the employer's liability ends there. If the investor messes up the fund, then it's up to the employee to bear the loss. But in a defined benefit scheme, the employer has to make sure that the employee gets the defined benefit. Okay, so now to focus on this a little bit more, let's get on to a past paper. Let's look at November 2011 question number 4, where it says that QWS operates a defined benefit pension plan for its employees, and at the beginning of the year they are giving the value for the plan assets as well as the plan liabilities, and then they are giving the finance charge on the scheme as 7%, and the actuary who does the calculations are saying that the current service costs of having this workforce for the year as 300,000. During the year we have made contributions to the plan up to 400,000, and to retired members the plan has paid 220,000 during the year. And so the general requirement of this type of question is for the examiner to ask the actuarial gain or the actuarial loss. So which is not a very difficult thing to do. Actually this topic is fairly straightforward. So you got to prepare the respective accounts of the plan assets and the plan liabilities, and generally all the numbers are given: the opening asset, the closing asset, the opening liability and the closing liability, and then the finance charge which you can calculate on the opening balance as you take it to the income statement, and contributions paid you debit to your asset having paid through cash, and any benefits paid to members you take off from your asset by crediting and deduct it against the liability by debiting to the liability account. And the balancing figure of the plan asset and the liability would be your actuarial gain or loss, which you set off from the two respective accounts and present it in the income statement under OCI, other comprehensive income, again under the subcategory, as I told you on day one, under items which cannot be reclassified. The interest cost and the interest income, you take it to the income statement, and the current cost is of course is an expense, and the net pension asset or liability, you take it to the balance sheet. And now if we can focus on share-based payments, so what some employers do is, rather than paying salaries, you offer shares. It's about share option schemes granted to employees, and whether we should account for it. Some people argue saying, look, there is no cash payment, there is no transaction, nothing to account. But in substance, why are we giving these share options? It is as a result in turn for employment services rendered. So we say it's a cost for the employer, and which is discussed under IFRS 2. So there are two broad types of share-based payments. One scheme is where you give share options, which we call equity settled. The other scheme is where a cash payment is made, where we call it cash settled. And now if I can take you through quickly a past paper question, let's focus our attention to March 2012, where they say that giving two transactions, as now you see in slide 92, KOL granted a share option scheme to 400 people, and you will be entitled to the option if you work for 4 years. Now a share option means it is equity settled. So what you do is, each employee is given 1,000 options, and you multiply by that by the expected employees at the end of the year. You start with 400. In year 1, so many people left. Estimated number of resignations is then again given, and that you multiply by the fair value at the grant date, and into the fraction 1/4 in the first year, 2/4 in the second year, so on and so forth. Then you would get the cumulative charge and the annual charge. And remember, you recognize the annual charge as an expense, and the credit is taken under equity because it is it's settled by way of share option. It's equity settled scheme. Now why I mentioned that is, even the cash settled scheme is very much similar. It operates the same way, but at the end of the day there is a cash payment involved, So when you account for it, therefore you take it as a liability, you debit your expense. Now in equity settled scheme you took it as a reserve. Now here you take it under liabilities. At the same time, because the liability has to be settled, at each balance sheet date the fair value of the option is revalued, is remeasured. So under equity settled scheme you take the fair value at the grant date and keep it at that, but under a cash settled scheme you update the fair value at each balance sheet date in arriving at the respective charge. Thank you very much, and I'll be back soon. Hi everyone, welcome to the final lab. We have gone through almost the entire syllabus. So let's take few minutes and concentrate on reporting of substance of transactions, and thereafter to look at some vital examination tips. If you take as an example, I'll take from FO. Let's take a lease What happens when we take, say, a motor vehicle on a finance lease? Who is the legal owner? The leasing company. But in whose books do we capitalize the asset? In the books of the lessee. Yeah. Who is using the vehicle and getting a benefit? Obtaining the risks and rewards of having the asset? The lessee. In whose garage are we parking the vehicle? In our house or in the leasing company? No, in the lessee's garage. Which means the risks and the rewards of having this motor vehicle is with the lessee. As a result, we would capitalize this in the books of the lessee. That's what we mean by reporting the substance of a transaction, where we would in financial reporting consider the commercial substance, which sometimes can be different to the legal form. So we'll have to ensure that financial statements represent faithfully the transactions which have been carried out, and that it reflects the true economic substance of the events and not merely their legal rights. Now let's take a few more examples. Let's say we have a debtor's balance. Recovering that is a little difficult. So we hand it over to a factoring company who gives us the money, advances the money, and thereafter it's up to them to collect the debtors. Now, can we de-recognize the debtors from our books to say, look here, debtors have been collected through the factor by paying a fee? Or is it that we are getting a loan from the factor, keeping our debtors as a security? Which is why I earlier said that we got to look into the substance, the economic reality. So, if the debts have been handed over with no recourse, it means that if something happens, the factoring company cannot revert back to us. If that's the case, we can de-recognize the debtor. Let's say if the debtor's balance was, say, 10 million and the factor gave us, let's say, 9.8 million, we can recognize the 9.8 million into a bank, get rid of our debtor's balance of 10 million, and the difference of 200,000 is our finance charge. Done. But if there is recourse where the factor can transfer any debts which cannot be recovered back to us, that means they are not taking any responsibility. Which means we cannot de-recognize the debtor. Which would mean that you hang on to your debtor in the balance sheet and recognize the money advanced by the factor as a loan by debiting to bank and crediting to loan. That's one example, debt factoring. And then we get into sale and repurchase agreements, where let's say I sell my building to a bank with the condition that I am compelled to buy it from the bank in 3 years' time. Now, what is the business of a bank? Their business is to give loans. So what is actually happening here? The bank is lending me some money over a 3-year period, keeping my house as a security. So can I de-recognize the building or my house from my balance sheet saying I sold it, although that's how we structured the transaction? We can't do that. We must always look at the economic reality. Now, according to my example, we cannot de-recognize the asset from the books, but to recognize the money advanced by the bank as a loan. So we talked about factoring of receivables, we spoke about sale and repurchase agreements, and another thing which we see in this reporting of substance is the sale and lease back. Sometimes you sell one of your assets and get it back on a lease, and some members try to keep it as operating lease, because then you recognize the higher charge and charge it to the income statement. But in substance, if it gives the characteristics of a finance lease, then we must book in the liability, bring the finance lease liability. Now some members try to avoid this. Why is that? Because if you bring in the liability, then your gearing ratio goes for a 6. Maybe that we have given a covenant to a bank to maintain the gearing at a manageable level, below a particular level. So we have to watch out for these transactions. And another transaction is where when we have consignment sales, to exactly identify the point where the sale takes place. Whether is it when the consignee receives the goods from the manufacturer or when they sell it in turn to another party. So, dear students who are preparing for the exam, watch out for substance of transactions. Again, you have to write and explain. Give your argument, and this can be in the section A of the question paper. So members, coming down to the last couple of minutes, if we can look at a little bit of examination technique as to why students fail the exam. Most students fail because they are inadequately prepared. Or in analysis questions, say the report, they lack commercial awareness. You just say some expense has gone up or the GP has come down without relating, without looking at the commercial substance. And then lots of children say, sir, the exam was easy, but we ran short of time. So time management is critical, and another important thing is show clear workings, so that even if the final answer is wrong, the examiner can award some marks for the steps. And some children, they give a nice long answer by repeating the same point. CIMA examiners are smart to spot that, and you won't be getting any additional credit. Remember, your examination is a time bomb. The moment they give the scripts, yes, the clock starts ticking. So the student is continuously under pressure for time. So the trick is to be ahead of the required run rate, because if you become under pressure of time, then our chances are remote. Then you can't think. So my special advice for you as we bring this program to a close is this. We got to capitalize on the 20 minutes of reading time. Now that's like a power play. Don't just wonder about the question paper, seeing what areas have come where you haven't studied. Pointless worrying anyway. My advice is focus on 1 or 2 areas where you have studied, and you try and crack the answer. Crack the answer into the you are not given your answer booklets. In the question paper, you can scribble some points down, do some calculations, whether it may be a share-based payment or a pension fund or a financial instrument or maybe a 10-mark consolidation. Yes, you can't use the calculators, but no one is stopping you from using the pen. Now, why I say is that then no sooner the writing time commences, that is the 3 hours writing time commences, you can quickly jot that answer down into your answer script in double quick time and save time. Let's say you manage to crack 2 questions in the reading time and you scribble it down, let's say taking 10 minutes, or let's say taking 15 minutes. For 2 10-mark questions, ladies and gentlemen, you get 36 minutes at the exam. So if you have taken 15 minutes to scribble it down what you cracked earlier, still you have saved 21 minutes. So now when you have 21 minutes as a saving, then you can comfortably get on to the main questions, the report, the consolidation or any other question, and you have the luxury of taking 3 or 4 additional minutes, which makes a world of difference. So for several questions, when you can take 3 or 4 additional minutes, definitely you are not under any kind of pressure, which will definitely increase your chances of passing. So members, cover the entire syllabus, do many questions on a time basis. Please do some mock exams where you do the real thing and put everything together. And whilst we bring this session to a close, let me wish you all the best, and may God bless you all, and thank you for your participation.